900 on the downside is the starting of that support zone, the 200-point support zone. We got 22,100 on the Nifty coming through, and the first rates are in 9 or 10 points lower. That's it, nothing at all. It's a flat start. 30 points lower on the Sensex. 72,750 is where that is coming through. Just a few stocks with news. Paytm, I think, should come up on your screen. It's been in news every day, but I think that's the one which is starting about 2.6% lower. Interesting, 416 is what that is starting at. But Sonia is on the wall with more rates. Sonia.
Okay, so let's kick it off with the Nifty itself, right? It's absolutely quiet, so flat, holding on to that 22,000 mark. But as you said, individual stocks are in focus, so let's get straight to it. First up, you have TCS is what I'm looking at. There is a big upgrade that has come in from UBS this morning. So TCS is the only one that's actually holding out on the green line. UBS is upgraded to a buy from a neutral and target price raised to 4,700, big upside to the current market price. Reliance is also something that I've been watching for a while. Today the stock is down 0.5%, but Reliance is actually up 35% from the October low. So it's put in a lot of ground, and some amount of profit taking is what you're seeing in Reliance now as we speak. Apart from that, Paytm, as you said, the stock is in focus. It has recovered 30% from the Feb 15th lows, and now the stock is up another 1.5%. Vijay Shekhar Sharma, of course, has stepped down, but the Payments Bank has reconstituted the board in order to drive compliance and better compliance. So that's something that the street likes. Vodafone, the board will be meeting today to consider a fundraising proposal. So, that stock is not doing much at the moment, but it has rallied quite a bit in the last couple of days. Power Mech is something I'm looking at. There's an order win of 396 crores that the company has got for a railway line in Chhattisgarh. So the stock is up 3.5%. Dixon Technology and Whirlpool are also on my radar. Jefferies has downgraded both these stocks to an underperform. Dixon is down 3.5% right now. Whirlpool, there's of course additional news flow that the parent company has reduced its stake. They've trimmed their stake in India. So Whirlpool is down almost about 5% Cello World is another stock that I'm watching out for. Motilal Oswal has initiated a buy. They have a target price of 1,100 on Cello World. The stock is up almost about 4% right now. And there are a couple of analyst meets. Polycab will be meeting analysts and investors on the 29th of February. Kajaria Ceramics will be meeting analysts and investors on the 1st of March. And Havels is also in focus as Goldman Sachs has upgraded the stock. There you have it, up almost about 2%. And finally, I'm also looking out for JSW Energy. There's an order win. The company will be setting up a 700 megawatt solar project. So JSW Energy is up almost about 1%. So plenty of stocks in focus. But the headline index, as you can see, is absolutely flat. Back to you.
All right. Thanks a lot for that, Sonia. Well, Havels, I think Nimish's standard brokerage report, that's the one that's flying away up close to on 2.5%. Big move is what we're seeing out there. You also have HDFC AMC. Well, that stock as well is up closer around 2% as we speak. And Crompton is participating on the upsides. A few of these names are doing pretty well. On the flip side, Alchem pulled back yesterday after the clarification, but that stock again is down close to around 2% as we speak. NMDC looking a little bit nervous. Global iron ore prices are in a bit of a tizzy, and that explains why that stock is under some pressure. You have a couple of other names like PFC as well that was down closer around 2% or thereabouts. So a fairly okay start. We're down mildly in the red for the Nifty, but from the broader markets, there is a bit of an outperformance that's coming in there. And advance decline ratio in favor of the number of stocks that are advancing, close to on 3 stocks advancing for 1 stock that's declining. Just want to pull up a few names. Easy Trip is up close to on 5%. Big up move is what you see out there. You have a couple of other notable movers. SJVN is up close to around 3%. And HFCL, I think they won an order, so that stock up close to on 2%. Prashant.
24 points lower is what we have on the Nifty, 22,000 and just under 22,100. Now, a few other names, right? I was talking about Paytm. Paytm started 3% lower. It's up 3%. So that's a 6% swing on Paytm coming through in the first couple of minutes of trade. So that's interesting. 440 nearly on that one, which is, it's come off about $100 bucks, more than $100 in the last fortnight or so. Data Patterns is coming up with a 2.33% gain. So that's large. With large volumes, actually. Ease My Trip has got about 5% gains. So, again, it's at the number 4 position as far as volumes go. Uniparts, it doesn't really show up, on the list in the morning, but 12% Uniparts on large volume. 600 plus on Uniparts is what we have. There is GICRE, ICICI, so insurance, GICRE, ICICI General Insurance, New India Assurance, all up 5%. 3 to 5% of these insurance names is what I can spot. We were talking about Idea Forge with Amnish earlier. Idea Forge starts another 4% higher. So one of those tough to find, good business, but beaten down in these in this market. And Cello, which Sonia was talking about with the Motilal coverage, that's up about 5% as well. So it's not a bad-looking screen at all as far as the broader markets are concerned. On the downside, Dixon is down 3%, Devyani is down 4.5%, and Alchem is down about 1.5% once again. And South Indian Bank, which had a bit of a one-way move up, South Indian Bank is down 12%. So it's got large volumes right now as well. And of course, Whirlpool, we highlighted earlier, down about 5.5% as well.
I think there's an adjustment that needs to be done
with
on that one. So yeah, I think so. That's the reason why. I think that will reflect out there. But a couple of large trades, Devyani, I think there's a large trade that's taken place. So we could look at that one as well. And that CMS Infosystems that our team said, that we are alerting our viewers on that. I think that as well has taken place.
CMS, I think, Nigel, it's a clean-out trade.
Yeah, it's a clean-out trade. The PE had close to around 26.8% stake, and that's got cleaned out. I recall having a chat with the management at their office, and at that point of time, the promoter stake was more than 40%. So it's gradually coming out. And this large trade takes place, means the overhang as well goes out. We'll have to see who are the buyers on the other side.
Absolutely. And I think Devyani also will see. Stocks down 5%. So that's a large cut that you're seeing right now. All right, well, let's get in Mukundan Siva. He's Managing Director, India Avenue Investment Management. He's joining us right now to take some questions on the market right now. India Avenue is a boutique investment firm based in Australia, and they have about 600 crores of assets under management. Mukundan, great to have you back on the program. Thanks very much for your time. I mean, I think from the last time whether we spoke, which is about a year ago, markets have done very, very well. Right?
Yeah.
In line with expectations, much better. Did you think we'd do this well?
No, I don't think anyone thought that. But I think there's been a few factors at play that have definitely benefited India. Largely, for an Australian investor's point of view, the demise of China and several attempts to play the China trade haven't worked out. So India has stood out like a sore thumb in terms of global growth, as well as the appeal of the market, and corporate earnings have been very robust. So I think that's increasingly being identified as by the foreign investor as a place to go.
Well, that's interesting, right? Because at a time when most of our global peers are going through recession, Japan, UK, we've seen what's happened with the China market, the property bubble there. The narrative is that more money will now come into India, despite the hike that the rise that we've already seen in the markets. Would you concur with that view? And is there more to go on the upside, you think, this year?
I definitely concur, because, as a business, we started 7 years ago, and it was very difficult at that point to sell an India-only story. And over the last 1 to 2 years, that story has become much more easier to position, simply because India's growth rate is a standout, as you said, relative to the other economies. And also, investors at the end of the day still chase returns. And the returns now, relative to even the US market, are standing out on top. So I think that's creating more and more of an appeal for investors to segregate India from emerging markets or global investing and take it as a standalone exposure.
All right. Hi, Mr. Siva. Good to see you in the studio. Give us a couple of names, though. Say, in the last 6 to 8 months, what have you added? And what are you looking to add? Because it's quite rare that you get top quality names at attractive valuations. Case in point being the private banking space.
Sure.
But you could name a few that you all have, increased your allocation or taken fresh allocation, say in the last 6 to around 12 months.
Yeah. So just on that, as part of our process, what we do is we select local fund managers that provide us advice to help us build a portfolio. So we invest as an FPI. We invest in stocks directly, but the advice comes from the local fraternity, because our view is you have to be in the Indian ecosystem and understand local ecosystem to be able to invest here. Spaces where we have made money in the last year to 2 years is real estate, pharma, where we've been overweight, as well as certain segments in industrials, and as well as autos. So there are certain stocks that have certainly benefited the portfolio, particularly in the pharma and real estate side.
But in a space like real estate, right, you were just discussing it as to how some of these stocks, like say a Macrotech Developers, is up 70% in the last 6 months. I mean, that's no mean feat. Do you think that there is more upside despite the rally that we've already seen?
I think you can relate that to Indian markets in general. There might be a phase where there's a time correction or a flatter period now because we've had such a steep ascent. But the medium to long term still looks more attractive than anywhere else in the world to me. So I think it's a matter of patience. And we know that things can't go up in a straight line. So it's just a matter of stock picking rather than passive or index buying. That's our view.
Okay. You know, you started by using the phrase China's demise. So, is it that? I mean, it's a very definitive thing to say,
Yeah.
or is the process underway? And I mean, the decline, right? I mean, it's not is it a demise or a decline?
Well, let's look at 3 years ago. China's weight in the MSCI EM was 40%.
Yeah.
Today it's down to somewhere closer to 25. India was 8%. And today it's up to 18%.
That's just a function of market cap, right? I mean,
function of market cap, but that's also, many investors who are structurally invested in China from 2015 to 2020 that were building exposure, who are now starting to quit on a sovereign risk concern. So from that perspective, I think people...
Is that still happening or is that yesterday's story? Because whoever wanted to leave, I'm assuming, would have left, right? I mean, investors, especially in equities, are forward-looking. So actually now the question is, are we at a point where you need to start to look at opportunities? I mean, it's a very large economy and I mean, you can't write it off.
Absolutely. I think what's happening is people will play it as a tactical trade and say, I'm going to China from a valuation basis because relative to India, the spread is massive. But structurally, I think a lot of those who are long-term investors would be much more cautious on that. You're still seeing a property sector which is, showing signs of weakness and continual fall in valuation. And most people's wealth is stored in property in China. So I don't think we've seen the end of it, but cyclically, it might be a time when people want to add some China exposure because of the valuation is so cheap.
What about some of the other spaces in the Indian markets? You know, there is this big debate about which sector will assume leadership between IT and banks, right? But both sectors have their own challenges. IT spending is a bit of a concern, especially client spends, and banks as well have some concerns on the margins, etc. Where do you see the scope of outperformance now?
I think medium to long term, IT still looks like a good sector to me. I think it's a slow but steady process that India continues to win market and profit and economic share in that space. When we look at some of the businesses, we see that they're under-owned and there's substantial potential for increase and more favorable valuation. When it comes to banks, obviously they're a market darling of foreign investors, and some of the valuations that they're trading at now look quite attractive relative to where they've been in the past. So those two sectors definitely for a foreign investor will come under more interest. I think once people play this China trade, then they'll come back to India again, and at that point you'll see these two industries do quite well.
So a longer-term relationship with India, but maybe a bit of a fling with China in the near term, so to put it.
Absolutely. I think India is adding structural investors. China might be adding tactical investors. That's the way I see it.
All right. One of the other things that support the Indian markets is political stability. And leadership at the top has been rock solid. Reforms, the PLI scheme, I think you have written about it in your note as well. What's your view? Do you think bulk of the good news is in the price at current reckoning? We have a big election, but the outcome is almost being priced into perfection.
Yeah, we saw that in December once the state election results came out, that the foreign investors basically said, well, it's a fait accompli. So I think it's largely priced into the markets. And maybe post-election, there's a sell the fact potential that might exist. But I think broadly, there is a lot of confidence in terms of the stability, macro, as well as politically with India.
All right, well, then we leave it there. A great conversation here. As always, appreciate you joining in with that perspective, and good to have you back here.
Thank you very much.
And one space that you spoke about, right, the real estate space, you said that you have been positive on that space. It's done very well and perhaps could go some more. Well, we have the management of DLF joining in, so would invite you to listen in as well to their commentary. The company has reported very strong bookings in Q3 with a surge of 261% year-on-year. They've also achieved the full year sales guidance in 9 months of FY24. Ashok Kumar Tyagi, the MD of DLF, joins us now to talk more about that. Mr. Tyagi, good morning, and it's always great speaking to you because, you know, we get to learn so much, not just about DLF, but about the situation in the real estate industry. So tell us, where are we at currently? What is the demand situation looking like between both affordable and premium? And what do you see as the tenure of the real estate industry over the next, say, 12 to 18 months?
So, good morning, Sonia. I mean, you know, where are we? I think we are in a good place. I think that's that's obvious. You know, in all fairness, I think now, I mean, it's almost been 2.5 years since this the current upcycle began. And frankly, every quarter, it's just acquiring stronger legs and, you know, moving across geographies and across price segments. If at all there's been a marginal slowness, I think it will be at the lower end of the segment, you know, but clearly, I think for most houses in the mid-range, premium, luxury and super luxury, and I think across geographies, you know, the markets have been very strong. The demand pipeline has been very strong. And frankly, from whatever pre-interest we are seeing for our future launches as well, I think that continues to, you know, sort of, you know, stay strong for the time period that you mentioned.
But are you seeing any slowness at all in the lower end or not yet? I mean, that's just
in
what
the
you're
lower
assuming.
end, look, we don't play in the lower end, Sonia, as you know,
Yes.
but clearly, you know, we are seeing, in fact, we're also seeing a couple of people who used to specialize in the lower end gradually migrate to the mid end, you know, from their licensing and launch standpoint. So I think clearly there may be some marginal slowness there. But I think in most of the ends, which are like the upper middle class and the relatively upper classes home buying, I think the segments are very strong right now.
Mr. Tyagi, hi, good morning. Prashant here. Yeah, you know, for this year, FY24, of course, you're going to easily beat what you said earlier in terms of guidance. And I think the pipeline for FY25 in terms of launches is also very, very strong. So could you talk to us a little bit about how that launch pipeline is developing? I mean, what should we expect in 25?
Have I lost you, Prashant?
We can hear you clearly, sir. But I think we may have lost the video. I can hear you. Can you hear me, sir?
Okay. Yeah, I can hear you somehow.
No, you're back. You're back. Audio and video. Please go on. Yeah.
Okay. So, you know, from the next year standpoint, we clearly have identified and outlined our launches even in our analyst presentation. I mean, we are looking at least, you know, 2 major launches in Gurgaon for sure. You know, one which would be a successor to the launch that we did in Q3 of Privana, and one which would be a more upscale luxury launch, you know, on the Golf Course Road. So those 2 launches will happen in 24-25. We should have a launch of luxury villas in Goa. We should have at least 1 launch in the Chandigarh Tri-City. And definitely we should hopefully have our launch maybe in Q2 in Mumbai. So I think we have a strong pipeline. You know, I think the total launch pipeline for next year is north of 30,000 crores. And I think we clearly hope that we can exceed the sales volume that we have generated this year.
Okay, all right. Hi, Mr. Tyagi. You set the tone for the interview, right? By saying you're feeling good and you know, things are looking up, and your tone as well is telling us more about it. But give us a few numbers then, if you can. You know, in the 9 months you've done around 13,300 crores of sales. What do you end this year with? And on that sort of a base, what kind of a growth could you look at? And you briefly mentioned about Privana too. Which quarter will that get launched in?
So I think it should get launched, I think, in the first half of next year. I think, you know, the exact quarter, whether it's Q1 or Q2, will depend on the entire, you know, approval processes of it, you know, frankly, in that sense. I mean, it should get launched there. I mean, we should definitely close, as you're right, that since we had exceeded our annual guidance in 3 quarters, I mean, our total annual sales volume for this fiscal should be higher than our guidance of 13,000 crores. That is very clear. And Nigel, traditionally, we give the guidance for the next year when we do the analyst meeting of the annual results, which would typically be sometime in May. So I think I'd say hold your horses for the next year's guidance. But I think clearly the markets right now and our launch pipeline support a strong guidance for next year as well.
Okay. You want to tell us a little bit about office income? That was flat this quarter at about 860 odd crores. How is rental income looking like in the commercial space, not just for you, but for the industry as well?
So I think, really the commercial, and I'll first talk of us and then of the industry. I think the last bit of the piece that was slightly holding back the commercial occupancy was the uncertainty around the SEZ space, and that the government, I think, was kind enough to issue those rules about denotification, etc. So I think even that last locked vacancy levels will start opening up. In our case, our non-SEZ vacancy levels were actually down to almost pre-COVID levels of 4 to 5%. It was the SEZ vacancy levels which were pulling the overall vacancy levels slightly up. But I think now that should get sorted out. I mean, we are clearly looking at a exit March 25 run rate, which is touching almost 5,000 crores on an annualized basis of the total cybersecurity net income, in that sense. And I think the pre-leasing for all of our existing offices is complete. We are building out, 1 to 2 million plus space in Gurgaon downtown. We are building a 2.5 million space in Chennai, which is completely leased out. We are building almost a 3 million square feet space in joint venture with Hines, for which pre-leasing has commenced. So really the pre-leasing scenario and the rentals are both very strong, The only thing, if at all, is that there's been a shift from third-party IT providers increasingly to global captives, GCCs as they are called. And it is those which are taking the big spaces now.
Yeah, no, I was actually going to ask you that, exactly that is this all captives, a large portion of it, and I think you answered
a large chunk of it, Prashant, are the global captives now, absolutely.
Okay. Just to come back to the residential side, what's been in 2023, calendar 2023, what's been the price on an average? I mean, different projects, of course, you would have priced differently, but what's been the price increase over 22? And what should we expect for 2024?
So look, I think it'll differ from individual specific projects. There are some projects where maybe the demand is far outstripping the supply, so there the numbers could be slightly awry. But I definitely say it's been a comfortable double-digit increase across the calendar 23. I mean 24. Let's see how it pans out. But I think clearly right now the pricing trends continue to be strong. I mean Privana, which we launched, I think we launched at a very good price point, and we got an excellent response to that. In fact, Privana, we also did one thing, Prashant, that we hiked the upfront deposit, the booking amount, from the conventional 10 lakhs to 50 lakh rupees, and yet we had 1,100 checks and a few hundred in the wait list, really. So clearly there continues to be a rush for good properties from credible developers. I think if at all the industry shift towards credible developers, I think is now a known story across geographies, not just in Gurgaon. And I think hopefully that sort of sustains for the next some time.
So in NCR, as you see it, I'm asking you this, maybe an unfair question, but it's such an important point that you make, right? Credible developers. So there's DLF. Who else is there in the NCR region?
Look, I wouldn't want to name specific names, but the fact is that people who are credible are clearly the ones who have launched, including a couple of at least one who is essentially a Mumbai-based developer who has come and done some good work in both NCR, in both Noida and hopefully Delhi. So I think clearly, as long as you are credible, you have a proven track record, I think the people are clearly willing to move to you. The unknown developers, I think, will continue to have a challenge, I think, because people still haven't forgotten the horror stories of the late 2010s. And I think that will still take some time to come out of.
So at least 10% price increase, just to complete that loop, into 24 over 23?
Yeah, I wouldn't like to make a forward-looking statement, because I think it will really depend on project to project, really, frankly.
Okay, all right. Mr. Tyagi, you announced your intention to acquire, I think, a 29-acre stressed asset in Gurgaon.
Yeah.
Could you give us a few details? What could be the approximate cost for this one? What are the benefits of acquiring this particular property? If you would have done some kind of rationale, some kind of maths as well, if you could share some details.
So, Nigel, this 29 acres is on what is called the Golf Course Extension Road. That's a micro geography where we had launched a project called Arbor about a year back. and we actually did not have any more land parcels there. And so this was a particular asset owned by two multinational, which had been mortgaged to two multinational banks. And for the last 1 year, we had been working with those banks and the erstwhile borrower. And eventually, we ended up acquiring the loan first, in that sense, which is a relative rarity for a real estate developer in India. So we purchased those bonds, and then we invoked the necessary regulatory processes, in an amicable and in conjunction with the borrower. And so, of the 29 acres, I think about 20 odd acres have now been conveyed to us. The balance 8 or 9 acres will require some degree of regulatory processes which are underway. From a cost standpoint, I think the total cost of this 29 acres to us will come to about 1250 odd crores. And I think there will be another 350 to 400 crores that will go into its approval to max the FAR. So I think overall, and it should be about a 7.5 million square feet saleable area that we'll eventually get from them. So, hopefully we will make our land investment on this transaction multiple times over in the course of the next few years.
Okay, all right. Can you tell me about this 147 million square feet land bank development as well that you're evaluating? What are you looking at in terms of execution? What is the potential from here on, and what's the idea behind it?
So, Sonia, we articulated a launch pipeline about 3 years back, which we have been executing. I think a large chunk of that has been executed. We have identified the next projects that we propose to execute. In fact, if you look at our analyst presentation for the December quarter, we have lined up, I think, if I'm not mistaken, about a 32,000 crore launch pipeline for next fiscal and a potential 40-odd thousand crores beyond that. So I think this will continue to be monetized depending on the markets and depending on our own execution bandwidth in a reasonable manner. We believe that the total land bank that we have, clearly should sustain us for definitely more than a decade. And we'll obviously, be open to opportunistic buying like the one that we did just now.
Okay. By the way, Mr. Tyagi, that Camellia project is sold out? I remember you saying that you're selling about 10 units a quarter.
I think last 20 odd units bachi hui hai, frankly.
Acha, the bees bachi hai. The ticket value is so large that...
So if the three of you are interested, we'd be happy to.
I was going to ask you about the Goa property, but you said it's a bungalow or it's a cottage, so then I can't. I'm looking for a smaller size house for my post-retirement, but that's why I skipped that one.
The Camellia project is...
But Nigel, watch out for the space on Goa, because this may not be our last launch in Goa.
Oh, indeed. I'm looking at it closely. I think the buyer is going to speak now, Sonia.
I already, my take on all of this is very different. I have one home that I live in. I don't believe in buying any more homes. I believe investing that money elsewhere. But that's a story for another day, perhaps.
By
what about you?
Absolutely the same as you in terms of philosophy. Mr. Tyagi, that it's what, 50 crores a flat now? What's the going rate?
So now I think it will be closer to 60 for the base flat. Yeah.
I see. Okay, got it. Mr. Tyagi, thanks very much for joining us. It's a pleasure having you
Thank
here.
you.
And good chat as always. And thanks for joining us. We'll take a quick commercial break here. We'll come back. We have the management of BEML joining in to discuss their third quarter numbers, business outlook, everything. Stay tuned. That's a special conversation you don't want to miss.
Welcome back. Well, let's focus on the next management. BEML, that's the one in focus. The company's Q3 performance a little bit weakish. The margins as well contracted by around 330 basis points odd, but the management has been guiding for far better times going ahead, and the stock has been on absolute fire. We're joined by Mr. Shantanu Roy, the CMD of the company, who joins us on the show. Hi, Mr. Roy. Good morning, and always good to speak to you. Thanks so much for joining in on the show. Well, I want to focus on a couple of aspects. First up, Q4 is traditionally the strongest quarter for BEML. And earlier you were guiding for, I think, a 20% growth. As of 9 months, it's still in low single digits. But Q4, I think you're expecting it to be quite a strong one in terms of revenue recognition. Do you stick to that number on revenue growth for the year?
Good morning, Nigel. We are in good times. And yes, the Q4 has always been much better as compared to the first 3 quarters. So first quarter generally %, second quarter is 20%, third quarter is 30%, and fourth quarter is 40 to 45%. Sometimes we have done 50% also. So I'm looking at something around 45%. So yes, that 20% growth is still possible. I can see it. Yes, there are certain headwinds, especially with regard to the supply chain, with regard to the geopolitical situation. But we are hopeful that we'll overcome all that.
All right. So just to get this correct, if you have to do this growth of 20%, Q4 you'll have to do 21 to 2200 crores of revenue. We're getting that right?
Yes.
Oh, that's quite encouraging then. So 20% guidance is holding on. The other couple of factors is,
the positive thing is that, we have the orders. We have the orders in hand to execute.
Yes.
We only have to focus on the execution and the supply chain.
Okay, tell us a little bit more about your order book. What's your current order book? How's the inflows been, and what do you end this year at?
The current order book is around 12,300 crores. The inflow this year has been around 6,600 crores, out of which Rail Metro has contributed around 58%. Defense has contributed around 25%, and mining has contributed around 17%. We anticipate a further order inflow of at least 2,000 crores, out of which 75% should come from the metro, and the balance 25% should come from defense and the mining.
Mr. Roy, hi, good morning. Can you just qualitatively talk about what is happening in each of these 3 segments? The rail metro, there's a lot of boom, defense again, a lot of excitement, and mining. Just tell us how you're executing in each of these projects and what's sort of top of mind as you see incrementally from here.
Very good morning. You see, all these 3 business verticals have different challenges, different strategies for execution. If we talk about the rail and metro, the rail and metro is basically a project concept. Every metro project or rail project, it takes at least 2 to 3 years to execute. The defense also is in the same category. Normally, it happens with the first off production model and the clearance, and then the bulk production clearance. And then we go for the bulk production. It normally takes 2 to 3 years. But mining is one area where the turnaround time is pretty less. In fact, if I get an order today, maybe in 2 to 3 months' time, we'll be in a position to execute. And we also follow certain strategies to see to it that it is executed in such a short time. So all these 3 different verticals have 3 different execution strategies. We are working on several execution strategies, including, the project management concept. We are also coming out with restructuring the company. And I am sure very shortly you'll be seeing in the next financial year restructured BEML, which can cater to the growing market demand, which can cater to an increased efficiency, and which can cater to quick decision making within the organization.
You led me to the next question, Mr. Roy. So just give us a broad sense of what we should expect. Nothing specific, but when you say restructuring very soon, in what sense?
Restructuring, you see, we are in 3 business verticals, and the 3 business verticals, we are in the process of further focusing, further breaking down, so that, the focus can be more. The focus can be on a particular product line That is what we are trying to do. And at the same time, my main objective is, one of my topmost priorities is to empower the people strategy. That is at the top of my priority. Number two is we should keep on contributing to the growth aspirations of the government.
Sure.
And number three is indigenization. These are
Right.
three of my top priorities.
So when you say restructuring, you mean internal reorganization, basically, sort of. Is that
Absolutely.
okay? Okay, all right.
It is not only reorganization. It's not only reorganization, but also breaking down the old structure and putting in place a new structure.
Sure, sure. Got it. I wanted your thoughts particularly on defense, because that is the space which is growing quite fast and the government has its keen eye on that. Earlier, you had said that you expect the revenues in defense to reach 5,000 crores over the next 4 to 5 years. Can you just quantify that for us in the very near term? What's the order book now in the defense sector? What is the order visibility like? And what kind of revenues are you targeting by the end of FY25?
You see the order book, of the total order book, defense has a contribution of around 25 to 30%, the present order book. In the near future, in the next 1 to 2 years, I can see further order inflow of at least 2 to 3,000 crores. And in the next 4 to 5 years, there are opportunity sizes of at least 40,000 crore for us. And we are very well on our way to achieving 5,000 crores of sales turnover from the defense vertical in the coming 4 to 5 years.
Okay. That's 5,000 crores of sales from the defense vertical. Got it. A couple of other high growth segments, right? The rail and metro segment is what I want to understand. What is the contribution that you expect from there? What is the kind of incremental orders that you're looking at?
You see the contribution of rail and metro last year, it was around 27% of the top line. I expect this year it should be a bit more, to 28 to 29%. As far as the incremental order inflow is concerned, I'm expecting at least some 1,500 to 2,000 crores of orders in the next coming 2 to 3 months. And if you look at the tenders which are already out and which are anticipated, there is an opportunity size of at least 12,000 to around 12,000 crores for the rolling stock for the metro only. I'm not talking about the rail sector at all. There have been some pushbacks for the tenders to the next financial year. Around 1,000 crores plus some big ticket tenders have been pushed back. If those also fructify, we are looking at an opportunity size of at least 40,000 crores from the rail segment itself in the coming 1 or 2 financial years.
All right. And Mr. Roy, just to confirm on the order book, 60% is from rail and metro. Are we getting that correct? And defense is 30% out of that 12,300 crores that you were talking about?
Yeah.
Okay, got it. A couple of more questions on the margin front. I recall you telling us there is scope for margin improvement. And of Q4, it's appearing to be a blockbuster because you're guiding for, maintaining the 20% growth, which entails 2,200 crores of revenues. Operating leverage will play out as well. What is the margin band we should work with? Point number one. And since you're going to be growing at such a brisk pace, what is the capex you're looking to spend, say in FY24 as well as FY25?
Let me talk about the margin first. If you look at our performance in the first 9 months, the PBT has seen an increase of 61 times over the PBT that was last year. That is number one. The EBITDA has an increase of 1% over the last year as of now. As far as the margins are concerned, last year we hit almost the double digits. And this year, I'm quite confident we will hit the double digits as far as the EBITDA is concerned. Now, talking about, the Q4 performance, yes, definitely, if the sales revenue touches these numbers, the EBITDA will further grow up and we can then expect at least 150 to 200 basis points in the EBITDA growth.
Give us the band, Mr. Roy. What is the EBITDA margin band we should work with? This 150, 200 basis points is coming about and you're sounding confident about it. What is the band we should work with on a steady state basis?
You see, the sector that we operate in is the capital goods sector. And, the EBITDA margin of 12 to 14%, I consider it very excellent EBITDA margins. We cannot aspire for 18%, 20% EBITDA, being the sector that we work in. I think
Correct.
your question regarding capex also I need to answer, right? So
Please.
I did not answer your capex. So this year we are infusing a capex of more than 480 crores, which should be around 10% of our sales turnover. And next year it will be further more by at least 20 to 25%. And this is primarily to ramp up our defense capabilities and to ramp up our rail and metro capabilities. Of course, mining, we are trying to replace our old machinery, old plants and equipment, and
Okay.
improve the quality and the efficiency. That is the thinking which is going on.
Mr. Roy, I'm glad you brought that point out because one section of the market believes that you're lagging some of your MNC peers in the railway division especially. I wanted to understand, why do you think that is? Is there some issue that you're facing in terms of quality compared to MNC peers? And, the R&D spends, would you be sort of upping that in order to, be step in step with some of the MNC peers?
Well, I'm surprised to know that, we are facing challenges as far as the quality of our rail and metro products are concerned as compared to our MNC peers. I believe it's the other way around. I mean, the quality that we have supplied for the Mumbai Metro, Line 2, Line 7, it's perhaps the best in the world. Number two, the Vande Bharat sleeper that we are going to bring out, I'm sure the quality will be much, much better as compared to the Vande Bharat AC chair car trains that we have seen in the market, that we have seen on the tracks till now. As far as our
R&D?
capability about the capability is concerned, so capability has got two aspects. One is the people capability. Second is the manufacturing capability. And there, since we are an engineering company, R&D forms a very important and integral part. So if you look at our R&D spend is around 47% of our PAT. If we take our revenue numbers, it's around 2.5%. And this we are going to ramp up significantly because we are investing a lot in the futuristic technologies, in the new areas like the engines and the power pack for different applications. So there is a huge focus on the R&D as far as the spend is concerned, as far as the intake of key skill sets of human resource is concerned.
All right, Mr. Roy, good to speak with you, sir, and good to hear that you're shaking things up. And look forward to speaking with you next. You said that reorganization, etc., will be soon, and I think that should propel execution even better. So great chat. Thank you very much for joining us, and it's a pleasure having you here. Stocks up about 3.5%. Markets, by the way, up about 6 points. It's not as if the market was down quite a bit, but there is green on the screen as things stand right now. We'll take a quick commercial break. We'll be back. All right, I think what we'll do is we'll bring in Sachinathan Utekar of Trade Bulls. He's joining us, and this is our segment Charting Trends. Sachinathan, great to have you with us here. Good morning. The market's been at a high, but at the margin, there have been concerns that maybe we are running into some amount of resistance because, maybe it's just that the gains were so sharp, but the market needs to consolidate. But how are you seeing things?
Good morning, Prashant. Clearly, I think when we look at the weekly setup, there is a good amount of caution which has been indicated by the price and some of the indicators. So I think going forward, what we have observed is that the market could remain more of consolidative. Every time we are moving higher, there's a good amount of profit booking evidence which has been displayed by the market. And on the lower side, it has been trying to defend the 22,000 mark. So I think the immediate range that has been exhibited here is that the support at 22,000 remains, very well built in. But on the higher side, 22,400 could be a supply zone, at least for this particular week. If you look at the weekly setup, if you look at the weekly charts, this is the first time wherein, we are getting a very strong evidence of a negative divergence. So probably, this is again reconfirming the fact that why after every, move on the upside, the Nifty has been facing a lot of profit booking. So if you look at the weekly scale, there's a good evidence of a negative divergence on its RSI. The weekly RSI has started trending below the 70 levels. And the last time when we saw that, this particular phenomena, we saw a very strong surge from the base at around 19,000 up to 20, almost around 22,000 22,000 levels. We did not see any major change in stance when it comes to RSI. But RSI right now for the last couple of weeks has been falling despite of the fact that the price has been rising. So it's a good indication that somewhere the confidence level of the trend is not that great. So probably we may see the Nifty continuing on the consolidation mode.
Okay, what about individual stocks? Anything that you like in terms of sectors or big trends that you're noticing?
Well, Sonia, I think Nifty IT has already shown a good strong run up. But if you look at the recent setup, even here the focus is on the negative divergence. And if you look at the daily scale on the Nifty IT, we have seen a good strong evidence of a triple top kind of formation. There is a good amount of supply pressure at near to around 38,000, 38,500 zone. And this is the first time when on its daily scale, the RSI value is falling below the 50 mark. So I think this is a crucial juncture. Probably we may see the Nifty IT displaying a correction. So we are of the opinion that sooner or later we may see a quick decline in Nifty IT. We may see the levels of around 36,000, 36,500. And after that, again, we may see the resumption of the trend. So right now, I think there is a good supply pressure here. And from the pack, I think Tech Mahindra has been one of the weakest counters. And this is where we are, looking at an opportunity to add some fresh short positions here. If you look at the weekly setup, we saw an engulfing bearish kind of formation at the upper end of the rising channel trend. And this particular formation, post this formation, we have seen a good amount of supply pressure. Even here, last week, we saw a kind of a spinning top on the weekly scale, exhibiting that there could be further weakness. The moment the stock starts trending below, 1270, 1265 mark, we may see this particular decline getting extended towards 1200, where its 200-day exponential moving average is also placed. So I think there's a good evidence that any opportunity on the upside should be utilized to create some short positions. Right up to 1300, 1320 would be an ideal zone. Keep a stop loss at 1340 and review your positions near to 1230, 1200 levels.
Got it. All right, Sachi, thanks so much for joining in and giving us that call, looking to create short positions on Tech Mahindra. Appreciate you joining in and filling us in with all of those details. Well, for the time being, though, we'll slip in a short break. You come back, we'll continue our focus on the markets. The markets, by the way, after starting off in the red, have moved into the green.
Let's now get a quick handle on what's happening in the world of commodities. Manisha Gupta is here to give us more on that. Manisha, morning.
Well, thank you for that, Sonia. I'm looking at the metals as a sector where we have seen prices continue to decline. Well, there have been some spurts where you saw some gains coming into the markets, but they definitely have not been able to sustain. I'll start with iron ore, where the prices are trading at a 4-month lows. We have seen a decline of 6% in the previous week, and there is further decline even after that fall that we've seen in the previous week coming in. It all has to do with the higher inventories as well. The Chinese inventories itself are at a 10-month high. We've seen 2% of gains in inventories on a week-on-week basis, and they stand at a tall 133 million tons as of now. It's not just that. When you look at the global iron ore shipments as well, that is at around 3-year highs. So that tells you that there is a lot of stuff moving around, but it's not getting consumed, and that's weighing onto the markets. If you have weak iron ore prices, and this is a major ingredient that goes into steel, that tells you that if the demand is not strong, that is happening with steel as well. So you have the steel prices also trading at a 4-month lows. The China home sales numbers fell around almost 34% in the month of January. And when you look at the home prices, we have seen a contraction continue into this one for a 10th straight month. So the numbers that have come in from China are all on the weaker side. So even as China has given out stimulus measures, etc., they have failed to make an impact as we see it right now. So if steel is down, that is seeing an impact on zinc then, because much of the zinc is used for galvanizing of steel. Zinc is actually the underperformer within the metal space. The investment funds have been the most bearish in zinc since 2018, and we have seen the prices decline by 8% in 2024 till time. If you look at the fund positions right now, they have been scaling their short positions. They stand at 60,000 contracts, which is 1.5 million tons of zinc itself. If you look at the markets itself, the stories, rather the inventories have continued to gain up as well. The zinc LME stocks are as of now at 2021 June highs at 228,000 tons. And when you look at the surplus situation, well, last year was a big surplus itself, and markets are anticipating that for this year as well, you could be looking at an even higher surplus than previous year of 367,000 tons. And this is happening even as markets are looking at various mines going under care and maintenance. You have some of the big names like Nyrstar, Trafigura, and a big mine, also a Tara mine, also has gone in for closing there. That one is in Ireland. So even as mines are closing down, because zinc prices now are very close to cost of production, even then the prices have been under pressure because there is just too much inventory lying around the world.
Okay, all right. Thanks a lot for that. Well, let's move on and let's focus on some stocks now. In fact, Whirlpool and Dixon Tech are down in trade today. There's been a downgrade that has come in from Jefferies. And of course, on Whirlpool, there is the specific news as well. Upasana is here to give us more on that. Upasana, over to you.
Well, Jefferies has written a note on electricals, and it has downgraded Dixon to underperform, and the target price is cut by almost 8% to 5,920. While the brokerage says that after 150% rally seen in the stock in last 1 year, Dixon trades at a higher valuation of 73 times FY25E. It has also downgraded Whirlpool to underperform, and the target price is cut by almost 11% to 1,125 rupees. It says that the Whirlpool's operating margin has now declined to 5% in 9-month FY24 versus seen about 9 to 12% from FY25 to FY21. Well, the brokerage says that the durables is a hyper-competitive market with a higher price elasticity. Well, that's the reason these two stocks will remain in focus today on the back of the downgrades.
Okay, well, Upasana, thanks very much for that. The market's absolutely flat. I mean, it's blinking red and green. 9 or 10 points lower is what we have. We'll take a quick commercial break here. Our segment, It's the Economy, comes up. Lada will get chatting with Sakshi Gupta, Vice President and Senior Economist at HDFC Bank. She'll also have Madhavi Arora, a lead economist at MK Global, to discuss the trends from government's household consumption expenditure survey. That's coming up. Stay tuned.
Hello and welcome to an all-important It's the Economy. Of all the data released by the government, the Household Consumption Expenditure Survey is by far the most important. It tells you exactly what a typical Indian family consumes. And depending on the changes in that consumption basket, in what the Indian household consumes, the NSO constructs the CPI index and even the components of the GDP. Now, the latest All India Household Consumption Expenditure Survey, covering 2.6 lakh households, comes after an 11-year gap. And what it shows us is that on the face of it, the pace of consumption growth has slowed a little from 2011 to 2022-23 compared to the previous 8 years, that is from 2004-5 to 2011-12. But what are the other key takeaways? Let's ask two economists, Sakshi Gupta, the Vice President and Senior Economist at HDFC Bank, and Madhavi Arora, Lead Economist at Emkay Global. Ladies, thank you very much indeed for joining us. Well, first up, Sakshi, what is the most important takeaway? Would you say that you have to admit consumption is a little slower in its growth?
Good morning, Lata. Yeah, I think for me, one of the biggest takeaway from this data is that while, at the aggregate level, you see that, the gap between the rural and urban consumption is, kind of closing and has been reducing over the last 11 years. But I think a large part of this reduction that we are seeing in this data is coming from the rural affluent. Right, a lot of the rural catch-up has actually happened at the top 20-30% of the income pyramid. And in fact, if you look at the bottom 20%, there the gap between the rural and the urban consumption expenditure has in fact increased. Right, so I think one of the biggest takeaways I have from this data is that there's a lot of unevenness even within consumption between the rural and the urban sector.
Oh, okay. There is still a gap. Madhavi, same question to you. For you, the most important takeaway?
I think I agree with Sakshi. One of the most important thing, of course, was the fact that the gap between the average urban and rural consumption, as a proportion of overall consumption of rural sectors actually dramatically reduced. But, one thing that most people are talking about is essentially that, how the rural poverty has actually, or the rural segment of the economy is improving at the margin. So there are a lot of mixed trends that we are seeing. As she rightly mentioned, if you look at the time series data, what we see is that the rural-urban divide has actually widened at the bottom of the pyramid, but has actually closed at the top end of the pyramid. But the good part, if I look at the this particular year's template, what we see is that the urban inequality and rural inequality actually has reduced. So within rural-urban segment, what we observe is that the consumption spending inequality between the bottommost 5% and the topmost 5% of the respective population of rural and urban has reduced at the margin, of course. But again, you are, growing economy, and, you're likely to see very non-linear pattern in these things.
Absolutely. Yeah, as you grow, the inequality will increase. And more importantly, why you don't perhaps see the inequality increase so much is how much more will you consume? Whether it is food or consumer durables, from the poorest to the richest, okay, it's 10 times more for the richest family compared to the poorest. But beyond that, the richer family will save. There is perhaps a limit to consumption, and perhaps there is no category called foreign travel, which will perhaps take some of the consumption. But Sakshi, let's get to the brass tacks in terms of how it will impact the most important index, CPI. Food is occupying less and less of a family's income, of a family's consumption?
No, absolutely. I think this data clearly has implications for how we calculate inflation. And I think subsequently, over the next 1.5 years, we should get a revised, CPI number as well. But, as is, typical of an economy where income starts increasing, a household would tend to spend less on essentials and food and start diversifying towards non-food items. Right. What is interesting in this data is that you will see that the top 3 commodities in the non-food space that the urban household is spending on is essentially conveyance, it's rent, and consumer durables. Right. But if you do a similar mapping on the rural side, I find it very interesting that a rural household actually spends a lot on medical expenses. So that's one of the top 3 categories where the rural household is spending on, right? So there's a lot of divergence between what the rural household and the urban households are spending on. I think from the bottom line is that when we are looking at inflation and when we are looking at a policy response going forward, given the fact that food is becoming less and less important, or at least the volatile part of the food basket, which is vegetables, cereals, etc., they are becoming less important. I think there has to be a greater sensitivity response towards the non-food side of the consumption basket, right, which is essentially core inflation. So I think going forward, there has to be a shift towards looking more at core inflation, perhaps, because that is, more than 60% of what households are spending on.
Okay. Yeah, actually, let's run the cereals household consumption series as well. We were running the food time series as you were speaking, Sakshi. If you look at cereals, it has fallen to 3.9%, if I'm not mistaken, in terms of the proportion of the household basket. It is not 39. That's a typo. It is 3.9% that it has fallen to compared to what it was, 12% or thereabouts. So, Sakshi, you think now you will have fewer and fewer politicians giving free grain. It is in any case not a very big component. On a more serious note, will it not change the CPI basket? And therefore, in actuality at the moment, perhaps CPI is lower than what we are seeing it to be.
Absolutely. I mean, if I were to do, analysis of what CPI would look like over the last 6 months, given these new weights, I would get a lower number for inflation because we know that a lot of the shocks or upward pressures have come from the food side, right? Vegetables, cereals, pulses, those have been the bigger pain point. So I would get, a lower inflation number. But I think there's another aspect that we also need to kind of think about, that there have been a number of government measures wherein a lot of the essentials, be it cereals, the free food grain program, you look at some part of the fuel and electricity, basket. A lot of this has also been kind of supported by, government measures, right? And therefore, a household finds itself spending or having more, discretionary spending available to spend on other items, right? So,
actually, Sakshi, Sakshi, let me just get Madhvi in on this. Madhvi, you think now when will the reconstructed CPI come? And is it likely to be distinctly lower, like, by 30, 40 basis points?
Correct. So, this is basically a summary fact sheet of the latest survey. So, we will have another survey, which is already underway. So, I think it will be completed by July 2024 is what was written in documents. So, accounting for the time period, with regard to compiling results and, in terms of working on change of index, I think the next series, which will be updated, most likely will be released not before July or August 2025. So we still have a long way to go. And if I really play that, the change in the composition of food versus non-food, I think clearly with the new weights of food and beverages, which we're trying to impute back into the series, the weight could actually fall from 46% to almost 40 to 41% in the new CPI series with regard to food. But one more thing that one has to keep in mind is that even though the share of overall food would probably be lower in the new index, the share of fruits and veggies are actually still going to be relatively marginally lower, not materially lower, which also means that broadly there's going to be no escaping from the occasional heat of potato, tomatoes and onions that you have seen in the past. More importantly, you would see a relatively lower impact of or a mixed impact of imported inflation, because while the share of edible oils probably has come off, you're also seeing an increased share of conveyance both in urban and rural, which is basically linked to fuel and food prices. So again, the policy response would be important in terms of how the transmission of imported inflation takes place. And third and most importantly is with regard to the non-cereal item, which is basically the protein led basket, which is increasing its share in the composition of food itself, would also imply that not only India is a protein deficient economy, it also is a supply deficient economy. So the policy response for food supply management has to also diversify from core cereals to probably pulses and other milk and other packaged goods and stuff. So I think the policy supply management chain also has to evolve in line with the evolution of consumption behavior of households.
No, fair point. That the fact that pulses have gone down rather sharply, but milk has remained fairly good, and so has vegetables. So there will be more volatility. But clearly, cereals going down in the CPI basket would take away about 30-40 basis points. Madhvi, the other, Sakshi, the other thing that hurt me a lot is that the share of education has gone down. This is not very good when we are about to encash our demographic dividend, would you say?
Absolutely, Lata, I agree with you that the share of expenditure on education, both in the rural and urban areas, coming down is a bit puzzling. It is difficult to say whether this is because of greater, access in terms of government schools, free education, or whether this is, showing you a more worrisome trend on the education side. So it's very difficult to basically dissect the two. But, for me as well, it was very surprising that the education segment it has such a, low weight, both on the urban as well as the rural side.
We cannot be sure whether it is because people are spending less or they are getting more value for money. We don't know. Madhvi, just a final question to you. The conveyance amount being so much higher, does that mean that, we have to shift from food subsidies to fuel subsidies? Clearly, either people are traveling more and that's why the weight is more, or they're spending more on travel. What would you take away from that as well? Consumer durables doing so well. Is that a sign of good prosperity?
So I think on consumer durables, I'd like to add one bit that the rural segment, if I see the growth, the CAGR of rural spending versus urban spending, there has been a much better behavior of rural in terms of shift towards durable versus the urban one. So that again sort of shows and especially at the top end of the rural segment. So that sort of shows convergence of rural and urban affluent to some extent. But that said, coming to the first point of yours where you talked about how we need to probably move our subsidy policy, which I also agree with. As I said that, there's been sort of a higher share of conveyance, which again is linked to fuel and crude prices. So, fiscal policy remains a big stopgap in terms of how the transmission really takes place into inflation. But of course, greater share of conveyance also means that higher inflation will happen when fuel prices rise if the government does not move its way towards, increasing subsidy in this line.
Okay, fair enough. We're out of time, but you'll have given us a lot of rich takeaways. One being that food is going to occupy a lesser space, and therefore perhaps the current inflation, which is largely food supported, is likely to have been lower if the index had already been revised, if we had had that 2017 survey, which was scrapped. The other important takeaway, education falling down. We have to find out why the share of education is lower, and conveyance going up. Is it because Indians are traveling more and that's why there is a bigger mobility bill? Or is it that they're traveling on private transport and the government has invested less on public transport? Is that the worry? But the important point is the household survey is such a rich survey that it is going to lead to policy changes and data changes in a whole host of things. So watch this space. We will have more interesting analysis coming up. Thank you very much, Madhvi and Sakshi. We wind up on Bazaar. Chartbusters coming up.